No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about a few different topics actually this morning. One of them being when it comes to retirement, and of course this is a good rule of thumb in general anyway, you need to be thinking in terms of how am I going to make sure that my money lasts. All right, this is one of the biggest concerns that we all have, is that we're going to run out of money during our lifetime, in particular when we're too old to go out and maybe do something about it. So one of the things that comes into play there when you start thinking of your retirement, it's all about, again, attaining and maintaining your standard of living and quality of life no matter how long you live, never having to worry about running out of money, and yet at the same time have the money to cover your living expenses, including discretionary expenses, what I refer to many times as fun money. When we start, when every day is a weekend and you've got the time now to be able to go out and do the things that you really enjoy, the leisure activities that you enjoy, the hobbies, family, whatever it might be, travel, whatever those activities are for you, to have the money to be able to do those. So not only covering the necessary expenses, but again, discretionary or again, fun money, those kind of expenses where we can travel and do the fun things that we enjoy doing. To make sure you can do that, you have to be a good steward of your money. And one way to do that is not just how you invest, that's one part, how I'm going to invest my money, if I'm going to be invested in the stock market, if I'm whatever, real estate, whatever it might be for you, however you're going to invest your money, that's one piece. And being safe there, being prudent, and in particular as we get into retirement, we're thinking now, I'm no longer just pumping money into my retirement accounts and I can ride out volatility like we're experiencing this year, but in addition, I'm able to basically benefit from it. In other words, from volatility, because when I'm putting money into my accounts every month, and they refer to this, by the way, in the industry as dollar cost averaging, when I'm pumping money in there every month, when the market's going down, I'm being able to buy I'm getting more and more shares, right? So I'm investing in whatever funds that I have selected or stocks or whatever it might be. And when the market's going down and those share prices are dropping, I'm able to get more shares for my money. Then when the market bottoms and goes back up, we see then that we've got more shares. We're going to benefit then from having bought those cheaper shares at the time that have now gone back up to their value and of course continue to grow, which is what the stock market does over time. But the key too is making sure you're invested properly, that you follow I talk about the principles of asset allocation and diversification, and making sure that you've got sufficient, a good portfolio, for example, might have thousands of stocks in it. And that's where we know that all those companies aren't going to go out of business, and that there may be some smaller companies or even the occasional large company that gets into trouble. But as long as you stay with it, the market has always gone up. And this is one of the reasons it's used as a hedge against inflation as well. Now, what we're seeing, of course, this year is the market is down, inflation is up, and we've got a dilemma, not only with stocks, but even bonds are down. So how do we adjust? In fact, I was looking this morning, just as before. Now, the market's looking like it's going to open up down, right, on Friday here. So we're looking at a day that could make, these numbers are likely to get even worse. So one of the things to keep in mind, all right, with where we're at, in fact, we're in a bear market currently. Usually when the market goes over 20% negative, okay, that's referred to as a bear market. And we're looking at if you look at bear markets in general, from 2000 through 2002, the market dropped 46%. It dropped 10% one year. It dropped 12%. This was in 2000. In 01, it dropped 12%. And then in 02, it dropped 23%. So 46% total drop. And it took about 7 years for the market to recover from that bear market. And then you had a period like in 08, from October of 07 to March of 09, the market dropped 55%. okay, and it took 5 years to recover from that. Now, I don't know if we're going to see anything quite that steep as we did back in '08, or as long as we did in 2000 through 2002, but it's one of the things you have to be prepared for when you're invested in the market, is understanding that statistically about 1 in 4 years are going to be negative years. And you're also going to see quite frequently drops of 10% or more, and less frequently drops of 20% or more. Usually that's about every 10 years or so. So one of the things we want to be thinking of in terms of the markets is how can we protect ourselves not only on the investment side, but also thinking beyond that in terms of our long-term plan. So let me share with you some numbers to start off. The S&P 500 is down 21.65%, and again, that's pre-market opening today, and a lot of the news doesn't look good. There's one of the things that was weighing, I think, was UK. They've given a big tax cut, and they're going to be paying that through borrowing. Not good. So we're seeing a big change over there as far as both stocks and that's affecting, I think, worldwide. It's showing. There's also news about how the world in general, as far as inflation and recession, looming recession goes, and for many already in recession, as we are here. We've had 2 negative quarters, likely to continue to see that occur. The Dow Jones is down about 17.79. The Russell 2000, these are the small companies. These are the 2,000 largest of the small companies, down about 24.21%. And then NASDAQ, right, the tech, which had really been quite the run here, and it's down. The NASDAQ index is down 30%. Year to date. So when we see these kinds of numbers, this gives us concern. And usually when stocks are down, bonds will help protect you. However, even the bond market's down about 12.45% year to date. So it makes it really tough as far as where to go for your money. I've also talked, and I did last week again, about fixed index annuities, and shared with you last week some advanced strategies even of how annuities can be used in planning. One of the things we've talked about quite often is there are some research reports. In fact, I'll give you an opportunity to get a couple. One of them is from Roger Ibbotson, and he's known for his bond research, and shows in his white paper, his research piece, how fixed index annuities have outperformed bonds over the long term. So it's a way to reduce your risk and increase your returns. In addition, there's another piece out by Barclays Bloomberg, and this one also talks about how utilizing fixed index annuities in place of bonds in your portfolio, or at least mixing, putting that in the mix, we'll say, can again improve your returns and reduce your risk. So this is one area to look. Is this maybe a time to take a look at maybe bringing fixed index annuities into the mix with how you're currently investing and with your overall planning? And again, with annuities, you can also use those. We've got very strong income annuities that can give you guaranteed income for life, and that can be for you, and if you're married, for your spouse, so for 2 lifetimes, if you will. Guaranteed income you wouldn't have to worry about outliving, income that will go up over your lifetime, as well as you'd never run out. Again, this guarantee, and this particular company on the income side nationwide is a very strong company. Athene is another. We look for the stronger A-rated companies, financially strong, that are also have the best products. So whether it's an income piece where we're looking to get the biggest income we can, or whether it's a growth piece where we're looking to get the most growth we can, and maybe blending those two together in your overall planning. So there are ways that you can, in fact, weather a storm like this. One of them, of course, if you're in the market currently, most of us are, and we're in, the market's down, as I mentioned, into bear territory. One of the things is staying disciplined. So when I talk about fixed index annuities, I'm looking to take something in place of bonds, right, and improve my overall investment, my overall portfolio. When it comes to On the other hand, with the so when I'm blending it in other words, I'm taking out bonds, not necessarily stocks, and that's important because this is not a time you want to necessarily bail out of the market, right? Because then you're locking in losses. This is a time to stay disciplined. Make sure, though, it's a good time to review your portfolio and make sure you're properly invested, all right? And if so, then again, to stay disciplined. I'm going to talk a little bit more about that after the break, and we're going to get into our program. We're going to talk to you about Medicare and how you can reduce your health care costs. That's keeping more of your money in your pocket. But first a break. Join us here. We'll be right back on the Retirement Report.